Gold and silver have been great places to be over the past 45 years, but it's easy to take a look at a chart like this and immediately be tempted to trade in and out of the metals in order to increase your rate of wealth accumulation. Over the years, I've come to conclude that gold, silver, and yes, cash can all be used to improve one's wealth. However, there's a danger that not understanding all of the factors that determine gold and silver's performance will lead to a person actually doing worse long term than just holding one metal or the other for the long haul and not trading them. It's very easy to overlook these factors and not even know the drag that they are having on your wealth accumulation over the years. And so I am putting out this video to help shine a light on some of the factors that are extremely important to consider. By the end of this video, you should have enough information to determine when taking a position in gold, silver, or cash is to your advantage, and whether or not a short-term valuation difference is worth exploiting. With that, let's get started. Here I've taken the average nominal dollar-based returns of gold over the past 45 years and plotted them on a simple graph. I've separated gold returns into groupings based upon a simple valuation metric that I use, which is the gold-to-oil ratio. Each of the colored circles here represents a gold-to-oil price in a given range. Along the x-axis, I show the holding time. So short-term holding times are towards the left end of the graph, and long-term holding times are on the right. The vertical axis is the average annualized dollar rate of return of gold. Now, I'll throw out the caveat once again that this data represents gold priced as a commodity and not gold priced as money. If gold once again regains its monetary role, then gold's dollar gain will likely be very high. I'd also like to state here that much of these gains are actually the dollar becoming less valuable over time. Ordinarily, I don't like charts where gold is shown in terms of dollars because it implies that the dollar is your ultimate goal and not gold. But since I'll be discussing taxes in a moment, we'll need to appreciate nominal returns in terms of dollars. A few observations can be offered about this graph. You'll note that there is a definite pattern in the data. Over short periods of time, there is a definite difference in performance depending upon how cheaply or expensively gold is valued relative to oil. Low gold-to-oil ratios are typically followed by a few years of very good returns. High gold-to-oil ratios generally have lower returns. The differences in returns are most pronounced for a 3-year holding period. We can see that the starting gold valuation is less important over long periods of time. This is because over the long term, it is dollar depreciation that determines gold's price gains in dollars and not any short-term revaluation effect. Let's add some trend lines to these patterns to make it a little bit more obvious. So I fitted some trend lines to the data. This will be useful to illustrate the patterns in the data and will allow you to use this plot to look up what the expected rate of price appreciation will be as a function of gold valuation and holding period. It's not a perfect fit to the data, but I think it's good enough to be a useful tool. Notice that over the long term, regardless of starting valuation, gold's return in terms of dollars has been 4.2% per year. This is mostly due to the long-term depreciation of the dollar, and partially due to gold becoming gradually more valuable relative to other goods and services priced in dollars. This chart can serve as a good guide for estimating the dollar price gains in gold. For example, gold currently trades at 3.5 barrels of oil per ounce. This means that the green curve on this chart is the one that's relevant to us today. If we look at the green curve, we can see that short term we expect gold to gain in dollar terms by about 15 to 20% per year. Over the long term, we would expect gold to produce gains in the 4.2% per year range, despite the fact that gold is cheaply valued right now. Given this, it is probably a mistake to consider using cash as a way to speculate and build wealth. Interest rates would have to be much higher than they are now to even make this a consideration. But the story doesn't end here. Costs and taxes are also very important to the overall picture, and so let's introduce a couple of other tools that you can use to adjust these nominal gains accordingly to figure out what your after-tax and after-cost gains are likely to be. Costs are extremely important over short time periods, so let's consider them first. This chart is a tool that you can use to take one-time costs incurred either at the beginning or the end of a fixed holding period and annualize them. In other words, this chart will give you your annual penalty that you can subtract from the nominal gains estimated on the previous chart. When you use this chart, you should consider the combined effect of all costs, which include the bid-ask spread, sales taxes, shipping costs, and credit card fees. This chart is valid whether you are dealing in gold, silver, platinum, palladium, or any other item for that matter. Each color on the chart represents a given cost level. The cheapest is 3%, which is where you can typically get down to with the purchase of a gold eagle. The highest I show is 25%, which is where you might be if you purchase small quantities of silver. I'm not showing higher levels of cost, but if you're not careful, you can easily incur costs much higher than 25%. So we can see here that if we incur a 3% one-time cost and hold for only 1 year at a time, then the penalty that we'll see is 3% per year off of our nominal return predicted from the previous chart. No surprises here. But if we hold for a much longer period of time, this 3% cost spread over many years becomes much less significant, and we end up with a much lower annual penalty. We can see that high costs are extremely damaging, especially if you have a short holding period. So if you want to flip silver for gold short term, managing your cost is critical to making sure that you don't end up with a poor result. Now let's move on to taxes. Capital gains are quite troublesome. One could argue that since it is really the currency that is depreciating in value and not gold and silver that are rising in value, that one should not have to pay capital gains taxes. But that's not what the IRS says. The IRS says that whenever you sell your gold or silver for dollars, you need to pay a capital gains tax of 28% on the difference between the number of dollars that you spent on the metal and what you receive in return. The responsibility for reporting the gain and paying the taxes is yours, but you should know that if you sell more than a certain amount of certain types of gold or silver in a given year, your broker may be required to report it. So we need to discuss taxes. Here I have pre-calculated for you the annualized impact of this capital gains tax for certain holding periods. The tax rate is a fixed percentage, but the penalty will be a function of the holding period as well as the nominal rate of return that you realize. So I've drawn some curves, each color representing a different level of nominal return per year. To help you understand this chart a little better, let's continue with the previous example of a gold eagle purchase. We looked up on the chart that gold valued at 13.5 barrels per ounce should nominally return 15 to 20% per year nominally short term and about 4.2% per year long term. So if we only plan to hold for, say, 3 years, we can estimate the tax penalty by looking at the 3-year point directly between the orange and red curves. This places the penalty at 4.5% per year. If we add to that a 1-year annualized penalty for the costs associated with the spreads and delivery, we see that our total penalty is about 5.5%. So instead of getting the full 15 to 20% predicted nominal returns, we can actually expect to keep only 10 to 15%. Longer term, however, the effect of the tax is much less punishing. We can use the dark blue curve to estimate the annual tax penalty, which turns out to be less than 1% per year. So our 4.2% predicted nominal returns for a 25-year holding period will be more like 3.4% after taking into account taxes and costs. Is 3.4% better than the after-tax return available on long-term bonds right now? It absolutely is. So we can see that taxes are quite important just as costs are. Let's look at the big picture and see just how important they are when considering the short-term advantages of paper versus gold. Here I've adjusted our nominal returns chart for gold to assume that we pay the 28% capital gains and pay a 3% one-time cost per transaction. Notice how much more condensed the differences are between the gains based on valuation. What was previously predicted to be a short-term gain of 25 to 35% per year for cheap gold is now 15 to 20% per year after taxes and costs. Still pretty good, but not nearly as good as before. For gold in its current valuation range, we were predicting 15 to 20% per year short-term returns, but after taxes and costs, we're down to 10 to 15% returns. Long-term, we notice that all curves approach the same level regardless of starting valuation, but now that level is 3.4% per year rather than 4.2% per year. So costs and taxes are both very important. Costs can be minimized by making good decisions when purchases and sales are made. Taxes are what they are, but both costs and taxes can be minimized in terms of their impact by simply holding for a long period of time. But if this isn't good enough, of an illustration to drive the point home, let's consider the impact of frequent purchases and sales, where the cost of each transaction is still only 3%. We'll even exclude the impact of taxes just now, just to be generous. Let's take our long-term average of 4.2% per year nominal return and look at the impact of what happens for different trading frequencies. If we hold for 25 years and only sell once and pay the 3% penalty at the end, then a $1,000 initial investment will return to us about $2,700, albeit inflated dollars. The cost penalty spread over 25 years is only 0.1%, and our total rate of return works out to be 4.1%. If we trade every 5 years, then we'll pay our modest 3% penalty every 5 years. Our $1,000 initial investment only returns to us about $2,400. Yes, the dollars are still inflated like before, but we have less of them now. Our effective return is now only 3% annually. By the way, I should highlight right now, just so that it is completely obvious to everyone, that the value I gave up in these meager transaction costs by making 5 trades over this 25 years is about the same as the value I would give up at the end by paying the capital gains taxes on the nominal gain. And we're not even considering taxes here. But let that sink in for a second. The cost of 5 trades, even with a paltry 3% cost for each trade, adds up to be almost enough to pay the taxes on a holding that is only sold once at the end. Let's take this example to the extreme and pay our 3% cost each and every year. The yearly drag on the nominal return is obviously 3%, and so our 4.2% per year inflation protection now only gives us a 1.2% nominal return. Our inflation protection is completely gone. But before we move on to silver, let's summarize this information for gold. We have seen that long-term, gold has a return that reflects the depreciation of the dollar. This has worked out to be about 4.2% per year, regardless of gold's initial valuation. In other words, even if you buy high, provided you hold for a long enough period of time, you will protect your purchasing power. You just have to be prepared to hold for a long period of time. There's also another shorter-term phenomena that gives gold a higher or lower return based upon valuation. The gold-to-oil ratio is a pretty good predictor of what this over and under performance is likely to be. You can use the chart that I supplied to look up the average short-term return for a given holding period and starting valuation. Of course, to capitalize on price swings, you have to be willing to sacrifice some of the advantage to costs and taxes. I provided charts that will allow you to look up an estimated penalty that you will pay the taxman and your broker. We've seen that these can be very important factors in determining gold's ultimate performance. Fortunately, these are fully within your control. Minimizing costs and not trading frequently are the best strategies for ensuring long-term success. The final factor that I should mention is noise. These charts were put together using averages. There has been quite a bit of variability of the data around these averages, so while the charts can tell you what the expected result is, don't be surprised if the result that you see in the short term is different. The longer your holding period, however, the more accurate the averages will be because the impact of the noise will be averaged out. Okay, I promised you silver investors some information that will help you determine when silver is a better bet than gold. The most statistically reliable measure I've found is the gold to silver ratio. Silver to oil still works, but it doesn't provide as clean a relationship as the gold to silver ratio. So here I've plotted 5 curves summarizing historic rates of silver performance relative to gold over the past 45 years. Each of these colored curves represents a different range of gold to silver ratio. Again, the x-axis is the intended holding period. We can see, just as was the case with gold, that cheap silver produces favorable results and expensive silver produces poor results. In fact, silver purchased with a gold to silver ratio less than 50 can be expected to underperform gold, regardless of the holding period. Silver purchased with a gold to silver ratio greater than 50 can be expected to outperform gold. The valuation effect is most pronounced for short time periods, and silver priced at less than 20 to 1 underperformed gold by a considerable annual rate. Silver that's purchased at a gold to silver ratio of greater than 60 can be a good long-term holding that can preserve wealth even more effectively than gold. It all comes down to valuation. Of course, I have to provide my disclaimer again that this all assumes that both gold and silver continue to trade as commodities. If gold is revalued as money, all bets are off. So what does all this mean for the prospects of gold versus silver going forward? We know that with a gold to silver ratio of 65, silver is likely to outperform gold long term, provided that costs are controlled. Can a person buy silver right now with the hopes of obtaining gold in the future at a better gold to silver ratio? Well, we can answer that question using the averages. Let's assume a 2-year holding period for silver. With a current gold to silver ratio of about 65, we expect an outperformance of about 5% per year in favor of silver, according to the prior chart, if silver is held for 2 years. So far, so good. Looks like a no-brainer for silver, right? But let's assume the costs and tax question. Let's buy some silver with the intent of minimizing costs. We can certainly buy silver in an unwise way and increase our costs quite a bit, but let's try to manage our costs. If we buy 50 generic 1-ounce bars at a price of $21.93 an ounce, we'll pay a total of $1,096. We're above $1,000, so we won't pay sales tax, but we will pay a delivery cost of $9.95. Let's pay by check to avoid a credit card fee. So our total cost is $1,105.95. The broker is willing to buy back the silver at $19.84 an ounce for a total of $992. Thus, the one-time costs are 10.3% of our total out-of-pocket expense. According to our cost chart, this is about a 5% per year penalty when annualized. Our nominal gain is expected to be 5% per year more than gold. At gold's current valuation of 13.5 barrels per ounce, it is expected to return 18% per year for a 2-year holding period. So we can expect silver to nominally return 23% per year for 2 years, which is gold's return plus the outperformance premium. According to our tax chart, this would generate a tax penalty of about 6% per year when annualized. Notice right away that all of silver's predicted outperformance for 2 years will be eliminated completely by the costs incurred in the trades. We can probably manage the tax effect. Most brokers are willing to do a trade without going through currency, but still, we'd be left with no advantage over going straight to gold right now. So in summary, at these price levels, silver will outperform gold long term, but short term, trading probably will not result in much, if any, benefit. So I hope you've enjoyed this presentation. I think there's some good information in here for those who want to consider it. So please leave your comments. Let's get a discussion going.